Right, good evening and welcome to this after-hour webinar on SharePad. What we're going to do this evening is I'm going to show you the entire process of picking shares and setting up portfolios and comparing them against each other in order to find your strategy, your winning strategy. So we're going to do this through several steps. First, I'm going to walk you through creating a filter, and we'll go step by step on that creation. We'll then pick some of the results. We will create a portfolio from those results, and we will then see how that so we can then see how that performs over time. And then if we have enough time, we can do it again and we can see how these I can show you then how to compare your different portfolios from different strategies to then find the one that suits you. Do let me know if the audio is okay. If it's not, if I need to increase or decrease the volume of my voice. So do please let me know. So without further ado, let's begin. So there were several different things. There were several different filters that I could pick. I did pick one which was based upon an article which Richard Bedard wrote a few weeks ago about Fundsmith. Now, Fundsmith is a very popular fund, and they have a certain strategy when picking shares. And one of the strategies that they follow is to apply certain filters, certain criteria to eliminate the chaff. There are obviously thousands of shares traded on the London Stock Exchange. Going through each and every one individually would be not very good. It would take ages. So what we're going to do now is build a filter of what we would consider the bare minimum that we want our share to have, and that will allow us to eliminate huge chunks of the market and have a much smaller list which we can then further analyze to find our investments. So to begin, we're going to build the filter. So the filter itself, I'm going to show you, it is this. So this is a Fundsmith filter. We will be building this filter. It's made up of 11 separate criteria. So we're looking for things like good ROC, gross margin, operating margin, so good profits. We want to make sure that the profits, that the borrowings on interest payments aren't too high, and that the company is producing has a good cash flow. We'll be eliminating certain subsectors because of various reasons. We'll get to that, and we'll also make sure that the company has been doing well for a long period of time. It just hasn't suddenly gone from being a terrible company to a good company. We want consistency in our filter. So if we go back to SharePad, we'll start off by creating a filter. So creating a filter, if you don't already know, we go to the filter menu above a list. We go to apply filter. We'll press the new button, so we'll create a new one. We'll give it a name and click on OK, and then OK again. And here is our blank filter. Now, first criteria is the Lease Adjusted ROC. The TTM that you see in front of a lot of these criteria stands for trailing 12 months. So we're not looking at the last reported year end, we are looking at the last 12 months. So for example, if a company has just released their Q1 results, the trailing 12 month figures will be calculated looking at Q1 for this year plus Q2, 3 and 4 of the previous year. So it's the last 12 months of financial results. So we go to add criteria and we search for ROCE, and here it is. And we want trailing 12 months. We want to exclude goodwill, and we want it to do lease adjusted. Lease adjusted means that it is going to take into account all the lease commitments for the company. We'll click on OK, and we'll set, we want the lease adjusted, oh, there we go, we want the lease adjusted trailing 12 months the trailing 12 months lease adjusted ROCE to be at least 10%. So we will click on minimum and we will put in 10, meaning it will eliminate anything for which the value is below 10. Whenever you make a change to a filter, a green apply button appears. So we press it and the filter will recalculate, and now all the shares for which this criteria doesn't match will be eliminated from our list. Now, one thing I didn't mention is I'm currently looking at the FTSE 350 shares. So this filter is going to slowly eliminate shares from the FTSE 350 to find our short list of interesting shares. You can apply this to any list you want. If I click on FTSE 100, the filter will now apply to only FTSE 100 stocks. I'm going to start with FTSE 350. The next criteria is gross margin above 25%. So we'll go to add criteria, and just as before, we'll go gross margin, and we want the trailing 12 months to be at least 25%. And now our list of FTSE 350 shares has dropped down to 108. You can also see the number of results at the top here on the blue bar. Continuing, we want the operating margin to be at least 10%. Now, the gross margin is the gross profit as a percentage of turnover. So that is simply taking into account the cost of producing whatever it is that the company then makes. So if a company makes a product, it will be the material costs of producing a product. Operating margin will look at operating profit, so this will also take into account fixed costs. Now, we want the gross margin to be fairly high, because if, for example, material costs increase, we want to make sure the company will still make a profit. If the company needs steel and the price of steel goes up, if it's currently making 25%, they might drop to 20% but the next year, but they'll still be making a profit. Operating margin is after we also take fixed costs into account. So of course that's going to be lower, because fixed costs then will change less over time, and so the operating profit will always be less than the gross profit. Next is going to be the lease adjusted net borrowing including pension deficit as a percentage of lease adjusted capital employed. So this is a little bit more complex. We go to add criteria and we go and look for net borrowing first. So we type in net borrowing, again trailing 12 months, and we want it lease adjusted, and we want it to include the pension deficit as well. Instead of clicking on OK, we click on combine items, because we want to see the net borrowing not as a value, but we want to see it in relation to the company's capital employed. So again, we press combine items, and we will select percentage of, and we select capital employed, and again it's going to be our trailing 12 months, and again lease adjusted, and we click on OK. And SharePad will do the calculation for you. It will calculate the net borrowing as a percentage of the capital employed. And we want this value to be less than 100% because we don't want all the capital employed by the company to be funded by debt. So we click on OK. And here, instead of setting a minimum value, we set a maximum value of 100. And we press apply. And the shares have now been, anything that is above 100 has been eliminated. The next item in the list is fixed charge cover. So, and we want that to be at least 2. So we go to add criteria, we select fixed charge cover, and trailing 12 months, and we click on OK. And these are the fixed charges for things like interest. And we'll set the minimum for 2. And we want to make sure that the company makes enough profits to cover all of these, all of the fixed charges that it has. Because a company could be making a lot of profits, but if all that profits is going to into servicing its debt, then it's not good. We then move to free cash conversion, and again we want that to be a positive value, so we want it to be larger than 0. And so again we select trailing 12 months, and we set the minimum to 0. The next item in the list is free cash flow yield. So again, this is a free cash flow as a percentage of the share price. Just as the dividend yield is a dividend payment as a percentage of the share price. So we'll go here and search for free cash flow yield trailing 12 months and click on OK and set it to 2. All these criteria that we're adding, again, they're not an indication of a good stock. They are a anything that is not included is definitely a bad stock. So we now move to excluding certain subsectors. Now, Fundsmith does exclude certain subsectors for a number of reasons. They could be a little bit too subject to volatility in, for example, certain commodity markets. So a company could move from doing very well to very badly because of circumstances out of its control, and because if you are if you're a mining company and the commodity prices of the thing that you mine suddenly collapse, then even if you are a solid company, the profits that you're going to make are going to suffer. So there are certain subsectors that Fundsmith eliminates. Now, I didn't write them all here because it's quite a long list, but I am now going to show you in the filter. So we go to add criteria and we select subsector and click on OK. And now we go down the list and highlight all of the ones that they exclude. So we want excludes, and we are going to exclude then asset managers, banks, coal, diversified REITs, exploration and production, this is in the context of oil, general mining, home construction, hotel and lodging REITs, industrial and office REITs, iron and steel, mortgage REITs, non-equity investment instruments, non-ferrous metals, platinum and precious metals, real estate holdings and development, and residential REITs, retail REITs, and the last one is specialty REITs. If you haven't followed entirely, give me 2 seconds and I am going to post that list onto the chat for you. Oh, did I miss home construction? Okay, let's go into edit. Oh yes, very well spotted, thank you. There's the list, and let me go and check that. So you said I clicked on... So I did. There we go. Thank you for pointing that out. So we have excluded all the various subsectors. So again, we hit apply, and the list will recalculate once more. The last 3 criteria are going to check to make sure that the company has been doing well over a long period of time. It takes a couple of samples. It makes sure that the ROC was at least 10% 10 years ago, it was at least 10% 5 years ago, and that the average over the last 10 years has been at least 10%. You could technically make sure that every single year, so do the 10, the 9, the 8, 7, 6, etc. years ago, but this is probably sufficient then. So we will go back to add criteria and ROCE, do trailing 12 months, and we'll exclude goodwill. Not trailing 12 months. We'll go, 5 years ago, excluding goodwill and lease adjusted. Okay. And then we'll do the same thing again, but for 10 years ago, excluding goodwill and lease adjusted. And the very last one is going to be the 10-year average. So to do a 10-year average, we do it like this. We pick ROC again. This time we select most recent. We then go to average over and select 10 years. So this means that it's going to start from a most recent financial report, going back 10 years, and calculate the average over the 10 years starting from most recent. If I picked this, it would calculate the average between what it'll do 1 year ago, 2 years ago, but it will ignore the most recent one. So we want the last 10 years, including the most recent reported financial year. So we'll select excluding goodwill, lease adjusted, and we'll click on OK. And now we can set our 3 values. So again, we want them all to be at least 10%. We'll hit apply, and here we are. We hopefully have eliminated all of the stuff which is probably not very good from FTSE 350, and we're left with 36 shares, which is significantly less work than 350 shares. Now, there is still work to do, of course, because again, these aren't necessarily great shares. These are just what is left after we've eliminated those that are probably not very good. How do we do that? Well, there are several different approaches. One that I find is definitely the easiest, again, to eliminate some more of the shares, is to look under the Financials tab and look at the summary of the company. So we can then go through share by share and find out and see if there are any shares that stand out as particularly good or particularly bad. So we'll go through a few of these, and we'll start off. We'll start off in alphabetical order, and we'll begin with Agreco. Now, Agreco is looking decent. It's got a good forecast P, 15.7, so it's not too expensive. PEG is a bit high, but as a good price to net asset value, good forecast growth. The one thing that is maybe slightly that might be slightly concerning is the slightly high debt, but the other is the dividend that hasn't been growing. We can see here that it has paid a dividend for the past 22 years, so uninterrupted. However, the dividend has not been growing. And in fact, if we scroll down, we do have a little chart here for the dividend payments. And we can see that the dividends have not grown since 2014. They have remained flat. They went down very slightly and then remained flat. Now, that is normally not a great sign, because good companies like to, even if but not by much, but they do like to pay out an ever-increasing dividend year on year, and the fact that they haven't might be not a fantastic sign. So we have 36 shares to look through, so we can be a bit brutal with the way that we eliminate shares that we don't like. Next one down the line is Ashtead. Now, Ashtead does look very solid. On the other hand, it has a low PE, not too low to be suspicious. It has good forecast growth across the board, so for turnover and pre-tax profit. A extremely low PEG, which is always very good. Debt, which is not too high. Binish M score. Now, this is a score that is used to estimate if a company is doing something potentially a bit dodgy with their books and manipulating some of financial data. And so a score of minus 2.55 is good. It's less likely that the company is doing anything not very savory with its books. Dividends. Now, the yield isn't very high. However, it has paid a dividend consistently for the last 13 years, and it's been growing consistently for the last 12 years. So we like Ashtead, and we can see also here that it has been growing quite significantly over the last 12 years. Not only that, it's also forecast to grow for the next 3 years. So we like Ashtead, and we would like to put it in our portfolio. So as I said, the next step is going to create a dummy portfolio with which we can test out the strategy. So we haven't yet created a portfolio, so we can do it like this. We select a share, we go to Add to Port, and we go to Add selected share to portfolio ... We click on it, and we'll create a new portfolio, which we'll call Fundsmith. We'll click on OK and OK. And now SharePad has created a portfolio and put Ashtead in it. So we can now continue through our list. The next share is Bar PLC, and here there are a couple of sort of red flags, actually a little bit more than a couple. The directors' holdings has dropped, so it looks like somebody has been dumping their shares, we can see. PE is quite high, and it is also not only high, it's higher than the 3-year average. As we can see below here, 3-year average was already pretty high. So despite the fact that it has been a spectacular share to own, it's probably not an ideal share to. It is probably, there's a good chance that this share might have run its course. Others might disagree with my analysis, but considering the the P ratio, and it's something that might have run its course. Also, if we look, the forecast growth in EPS isn't huge, so if it does hit a 4.4 growth in EPS, that will still mean that the P ratio will still remain very high. Bearish M score as well is also not fantastic. So we'll skip this one and move on to the next. Bodycoat, on the other hand, this looks good. Their EPS growth is slightly negative, and the this is sort of EPS is, again, yes, slightly negative, but the pre-tax profit and EBIT and turnover look like they're rising. It's not expensive, 14.1. Of course, it's not particularly low, but 14.1 means the share isn't particularly expensive. Not only that, the institutional holding of Bodycoat has increased dramatically over the last 3 months, which would indicate that there are some very big investors that are buying up the share. So again, these are all good signs. So let's decide that this is going to be a good share, and we'll add it to our portfolio. Now, we've already created the portfolio, so we don't need to create it again. If we go to add to portfolio, we'll just simply select the one that we've already created and click on OK. Now we can go down the list, and next share here is Burberry. Now, with Burberry, of course, one thing that we haven't looked at, which might be, well, is definitely quite relevant with a lot of these shares, is how Brexit is going to impact the company. Now, there are lots of things that could impact the company because of Brexit, and there's obviously complicated supply chains to take into account. But a good way of, again, at a glance, having a look is to move over to the Company tab. And in the Company tab, the program will give you the activity breakdown by region. So we can see where the source of turnover is, so the source of revenue for where the company comes from. So we can see that the biggest source of revenue is from Asia Pacific. I guess it's probably going to be China. And we can see that it makes almost 40% of its turnover from Asia Pacific. However, Europe, Middle East, and Middle East and Africa is as well pretty high. Now, unfortunately, the company does report Europe, Middle East, Africa all as one block, so we don't know exactly what percentage of that comes from Europe itself, but it is quite high. So, not necessarily, but it's always something that we should take into account, and we can see that yes, maybe Brexit could have a detrimental effect on especially this source of the company's revenue. So it is something to take into account. If we're not too sure, we might decide, well, let's skip Burberry. Let's move on to the next one. Now, we probably won't have time to go through all 36, so we'll just pick a sample of a few more. So we'll have a look at, let's have a look at IG Group, for example. Okay, well, IG Group is possibly a good example of something that we might want to avoid. It looks like the forecasts are just bad across the board. The average turnover the average turnover over of IG has been 11.8% over the last 3 years, so it's grown by 11.8% on average. It's forecast to drop by 19.5%. EBIT, pre-tax profit, EPS, Benisham score is not great at all, so probably yes, this we can skip. Pearson, again, it's not very good. Not only that, also the broker consensus isn't fantastic. Now, I'm always have to take the broker consensus with a giant pinch of salt, but because brokers tend to overhype a company, if they do give an underperform, then there's probably a good reason for it. So again, let's ignore Pearson. Move down to the next one. We've got Reckitt Benckiser. Again, Reckitt Benckiser looks good. The P is a little high. It's probably a little higher than we'd like it, but not by too much. Forecast growth is again not stellar, but it's solid across the board. And again, Benisham score is good. Debt is low, and as well, if we look at qualities, are good ROC, CROCI, EBIT margin. These are all decent things. And we could probably go and look into Reckitt Benckiser in a little bit more detail, but again, it's all good. Dividends are good as well, increasing over time. So let's put Reckitt Benckiser in our portfolio. So. And we'll pick one last share, and again, Smith's Group at a glance looks solid. Turnover increase is forecast to increase, and it's by 5.2%, which is better than it has over the last 3 years. EBIT, it's slightly down on the average, but still positive. And pre-tax profit and EPS look to be growing faster than they have over the last 3 years. Debt is still good. So again, debt to market capitalization is still not too high. It paid an increasing dividend over the last 8 years. So again, that's always a good sign. Yield is decent, 3.1%. is not stellar, but it's always a nice little bonus on top of any capital growth that you might make. So let's go with Smith's Group. Please don't take my analysis for the end all, because as I said, I am analysing these shares on the fly quite quickly, so I can get the webinar done in an hour. So obviously, these you might want to look at news stories as well and charts before you make the decision. However, whatever method you use, then you don't have to go and throw yourself into actually buying the shares. That's what we're doing here. We are creating a dummy portfolio, and then we're going to see how this works. So we've got 4 shares in our portfolio. That might be a decent start. We'll probably want a few more, but let's stick with 4. We'll exit the filter, and now let's go in our portfolio. So we go to Port. We'll press Select Portfolio and select our Fundsmith portfolio and click on OK. So here we are, our 4 selections. Now, creating a dummy portfolio works exactly the same way as you would create a real portfolio. So we're just doing it with pretend money. We'll go to the transaction sections of a portfolio, and we will dump a hypothetical amount of cash in this portfolio. So we'll go to Add Cash Transaction, and we'll credit the portfolio with £10,000. It doesn't really matter how much you credit, as long as it's always the same amount across of all of the portfolios that you create for all the various strategies. So that way you can easily compare the performance of all the different strategies. We're going to set this to a date. We'll record all the purchases with today's date, and we'll just set the credit to the day before. So, okay. Now our portfolio is worth £10,000, and then buying the shares is fairly straightforward. We'll buy them at the close price. You can, you could do this live while the market is open and buy it at the actual offer price. But market's closed now, so we'll pretend that we bought these shares at the price. This is a long-term strategy anyway, so the difference between the close price and the price at 4:30 is probably not sufficient to give to alter the overall performance too much. So we'll go through and just buy the shares. We go to add transaction, we'll go to buy. Now we put 10 grand, so we'll put 2,500 pounds in each. We will put we can put charges as well. We'll put £10 in charges, and if we want, or we can just keep this clean and just ignore the charges, and we're just looking at the performance of the portfolio. And if we'll put 2,500. Oh, sorry, doing the wrong thing here, and. And so we got to it's 19. And we'll go 6. Okay, so that's going to be our 635. There we go. And that is probably as close as 2,500 as we're going to get. So there we go. The date, we'll record it with today's date. Time doesn't really matter. Time is only relevant if you are recording multiple transactions in the same day. If the order in which those transactions occurred is important. But so if we made multiple transactions for Ashton on the same date, then yes, the time will determine the order in which they appear. But it doesn't matter here because there's only one transaction. And we'll just go through and repeat the process. So we go to add transaction, record a buy. There we go. We recorded the transaction in our portfolio. It's now active, and we can now keep an eye on it to see how it will perform over the next few days and weeks. We'll go back. We'll create a different filter that will pick up shares. It's a different set of shares, and we will then create another portfolio, so then we can pit them one against the other. So the next filter that I wanted to create is going to be based upon Greenblatt's magic formula. Now this is going to be an extremely easy filter to build because a Greenblatt magic formula is already built within SharePad. So we'll open up the entire London Stock Exchange. We'll go to filter, apply filter. We'll create a new one. And click on OK. The criteria is just a single one, the Greenblatt magic formula. So we select Greenblatt magic formula, and we will simply select lease adjusted and including intangibles, and we'll click on OK. So the Greenblatt magic formula, all it does is it will sort the list of it will sort the list by two metrics, and you can see here that it will look at it, it will sort it by return on capital and EBIT yield. It then combines the rankings of those two metrics and creates the final ranking, which you see here. So the number you see is just the ranking of the share. It also excludes certain sectors as well. So the share that I've got, Smith's Group, it's 200. It's in the rank is 207 out of the entire London Stock Exchange. We don't want all of the shares that actually have a rank. We only want the top 20. So I'm simply going to put maximum 20, hit apply, and then I can sort it. There we go. This is from the number 1 ranked to the number 20 ranked within the entire London Stock Exchange. Oh, I saw a message has just come. I've just noticed there's a message. Will you be creating an accessible Fundsmith filter in your library? Yes, we already have. I wanted to go through building a filter to help you sort of see how filters are created. But yes, you can be yes, you can just go to the filter library. If we go to filter, apply filter, library, and just simply search for Fundsmith, and here it is, Richard Bedard fishing like Fundsmith, based on the article that he published. And so yes, any article that we publish on our website, if it has a filter, we will always build that filter and put it on the library, so you don't have to worry about creating it. But it's important to know how filters are created, because we're not the only source of knowledge. You could read up something on the Investors Chronicle or some other website, and you'd like to build that in SharePad. So it's good to know how to build those filters then. Greenblatt magic formula. So here they are. They're the top 20. Now, again, we probably don't have the capital to invest in 20 shares, because again, if we have our hypothetical £10,000, that will only be £500 in each, and it will be eaten in by trading costs. So again, we'll stick to we'll probably pick 4 or 5 that we like, and we can go through and proceed in the same way. One of the things that you should always make sure, even when you are magic formula investing, is to make sure that your the picks are diversified. So if the first 4 shares or 4 or 5 companies are in within the same sectors or sector or subsector, then you shouldn't probably pick them all, but you should pick some from the slightly lower ranks, just in order to diversify your portfolio as much as possible. Again, using the Greenblatt system, not all of the shares are going to do well. You might pick a dud, but the idea obviously is that the good shares are going to outweigh then the bad picks. So what we can do is, we're not going to add it as a criteria. We'll just add a column with subsector. We're not excluding any subsector, we just want to see what the subsector is. So yes, so for example, here we've got 2 iron and steel companies, and yes, and given the choice, we have Ferrexpo and Evrats, and based upon what the forecasts are, then definitely Ferrexpo looks like the better pick at even with a very quick glance here. The dividend here, it looks like it's being slashed, and everything else is being slashed, so we can add this. So we'll go through the same process as before. Go to add to portfolio. The program will always offer for you to add the share to the currently active portfolio. The active portfolio is simply the last portfolio that you're looking at. So it'll always offer. Now it's offering to add the share to Fundsmith. We don't want that. We'll select the one below, add selected share to portfolio, ... and this will open up the choose a portfolio box. So there we go. We'll create our Greenblatt portfolio, and then we've added Ferrexpo to it. And And again, we said we wanted to find five decent shares, and so we'll go through and find some interesting. Now, this is quite interesting. There's again, broker consensus is always again something that you should take with a pinch of salt, but a big sell here from consensus. This is probably might ring alarm bells, so it is worth investigating a little further why the consensus is currently at a sell. On the other hand, you have to also be careful about the buy consensus, because the consensus that you see here is simply the average consensus from all of the brokers that have put through a opinion. Now, if you're looking at a FTSE 100 stock, that opinion is probably made up of 10, 14, 15, 20, 30 different brokers. When you're looking at a much smaller company, then the number of brokers that actually write reports on them gets smaller. And there's one thing that I might point out is you can find out how many brokers that is. You can't see who they are because after the MiFID II regulation came into play, the broker forecasts are anonymous. We can display what the average forecast is, but not what the individual broker's vote was, and the individual broker's forecast was, and who they are. However, you can see how many there are, and we can see that currently there are just two brokers putting through an opinion. So there's 0 here, 2 here. Now that can be considered. We don't know who those brokers are. However, if we go under company and scroll down under advisors, we can see that there are 2 stockbrokers that are charged with selling the shares in the company, Canaccord and ThinkCap. And sure, we can't tell that those forecasts were published by Canaccord and ThinkCap. However, considering it's only 2, the 2 that are more likely to give out a buy recommendation might be the ones that are also are in charge of selling the shares in the first place. Again, there's no way of knowing that if this is true or not, but again, always look at do have a look at actually how many brokers of the forecast are based on. If it's 30, then yes, it's a lot harder to manipulate than the figures from one or two stockbrokers to manipulate the figures, but it's a lot easier if there's only 1 or 2 stockbrokers that are issuing forecasts. So always something to bear in mind. And because of that, maybe we can skip. Do we know the date the broker forecast was made? Unfortunately, no. The forecasts in the program are updated on a daily basis. So the information that was released today at midday was based upon any changes in forecasts that were issued yesterday. So if any broker issued any update to any of the figures, any of the forecasts for any company at any point today, all that information will be collected throughout the day and will be in SharePad tomorrow at lunchtime. So by tomorrow lunchtime, you'll have any changes. So again, the information is changes on a daily basis. But you can't see when a particular broker changed their forecast. However, you can see when the average changed. Again, all you need is one broker to change their value for the average to change, and you can see that. As we're at it, let's have a look at that. If you go to forecasts, we can scroll down and we have all the figures. We've got some forecast turnover and EBIT, etc. But we also have the history of the change. So at the bottom here, it says forecast item turnover, and we can see now currently the forecast turnover for the 2019 financial year is 2.8 billion, so 2,800 million pounds, which places it here. However, we can see that the forecast turnover for 2019 was significantly higher back in the end of 2019, end of 2018. So we can see here, this is probably around August time last year. This is the beginning of 2019, and we can see it how it's changed over the last 8 months, 8 or 10 months or so, and we can see that it has dropped over time. So you can see how the figures have changed over time. But yes, you can't. There's no way of knowing when any individual broker has updated their figures, unfortunately. Again, this is down to the changes in with the MiFID regulations. So love to see brokers' buy recommendations plotted against a price chart over the years. How much correlation? Well, again, there is something quite interesting about the buy recommendations, and let's have a look at that. We are slightly digressing, but it seems that you are interested in this, so we might as well. I'm looking at the entire London Stock Exchange, and I have here the broker consensus. I will sort the list. Okay, there's a bunch that have no opinion, which is fair enough. Then we move on to the buys, of which there are a lot. We are moving then to the outperform, which used to be weak buy, but now it's called outperform. And there's a few of those. Holds, there's a few of those. And the underperform and sells are just not even a couple of dozen. So, again, read into that what you will, but but again, you could easily build a portfolio looking at all the buy recommendations within a certain sector, for example, and see how that performs over time. There's you can pretend to have you can see where the opinion was as well under the finance forecasts. You can see let's pick a slightly bigger company with more opinions. There we go. So we can see where the opinion was back in 2018, 17, 16. So we can see the change in opinion over time. You could simply pick and decide to invest in any share that was a buy recommendation back in 2017, build a portfolio and see how that performed, and then decide then for yourself. So right, getting back on track. If we go back to the Greenblatt magic formula, and we go to the LSE shares, and we will pick. I don't have a huge amount of time left, so I'm going to do a. There we go. I'm going to add this share to the portfolio. There we go. This isn't a this isn't really a great way of picking the share, but I'm just quickly trying to finish what I was trying to say. So we pick this, we'll add it to the Greenblatt portfolio, and we then go and open the Greenblatt portfolio. We will repeat what we did, and we will add. Again, important here now, because we're going to use this to compare the performance over time, to make sure that you add the same amount of money on the same date, and so you can compare apples with apples. We will record. This time we'll put £5,000 in each because it's only 2 shares. So that is 2.1. Okay, and we will record a buy against Ferrexpo for a price of free and 2344. Data today, fantastic. And then against Taptica, we price of £1.40, so that will lead us to purchase 1,785 shares at £1.40, and today's date, and great. Now, we've built our portfolios, and we can then compare the performance. The easiest way of comparing the performance of portfolios is to use the My Portfolios button. If we click on it, it will just give you the current value of all your portfolios. And if you are testing various strategies, just make sure that you start all of your dummy portfolios on the same date with the same amount of money, and then over time you can easily check how they've performed. And all you do is then you can click on any one of those portfolios to view their performance over time. Obviously there's not much useful information at the moment because we've recorded it with today's date, but over the coming days and weeks we will see how the Fundsmith method and the Greenblatt method then deviated. And yes, experiment. There's a huge amount of material then that you can have a look at on our website, and as I said, if you find an article on the knowledge page on our website, and if we go to we'll go to sharepad.co.uk, and if you go to articles and insight and go to all articles, you will find all of the articles that have been published by our writers. If you're searching for anything in particular, you can just type in the search term. So again, if you're interested in looking at the searching for Greenblatt, there we go, search, and it'll find any article that mentions Joel Greenblatt, and so you can go through and read them. So there's a ton of stuff here with loads of suggestions, and yes. So my advice: do have a read through, do increase your knowledge, and do pick strategies that inspire, that you like, and that you, more importantly, that you completely understand. So you can you understand why things are being done that way, and then pit them against each other. And that's always the best way. Don't go charging into just by just randomly picking whatever a filter spits out. So do go through, test them against each other. You'll find out that some are great and some are terrible, and then if the great ones continue being great, then that can be your strategy for the next 5, 10, 15, or the rest of your life. So do have a look at that. I have managed to squeeze everything within the hour, but I will just hang along here for a bit. If you have any questions, this is I'll wait here. So yeah, please ask away on the chat, and we can discuss anything that you wish to ask. Right, Michael, is there a way to output portfolio performance to an Excel spreadsheet? You can export the data from the portfolio to a spreadsheet. Now, you can do this under the sharing menu. If you click here, you can export the data in 3 different ways. Export transactions to file will just export a table containing this, just every transaction you made. The export holdings will export this data, so it'll show you what your current setup is. And the one that you want is export performance data to file. This will export essentially the data which makes up this chart onto a file, so you can then look at it and manipulate it in any way you want. So it's just the numerical values of what is appearing on the chart. Naresh, yes, absolutely. It wasn't something that I was planning on covering tonight, but yes, absolutely, you can filter using technical analysis strategies. The side, if we disable this, if we go back to filter and apply a quick filter, just call it TA. Oh no, because that's too short, so it doesn't like that. Okay. Okay, technical, click on OK, and here it is. We go to add criteria, and all the technical criteria are criteria are here. So you can look at anything like average volume, candlestick patterns, moving averages, pointer figure charts, trend lines, and any of the indicators. So very, very quickly we can build a moving average crossover split criteria filter. So we want to find when a 20-day moving average has just crossed above a 50-day moving average, and so we go to moving average. We want to look for golden cross, which is when a short-term crosses above a long-term moving average. We'll do exponential 20 crossing above exponential 50. We're looking at a daily chart, so period daily, so this is going to be 20-day and 50-day. You can pick weeks or months if you'd rather, and look back 5 days. This means that we're looking, it will find any share where the cross has occurred at any point in the last 5 days. So it could have happened today, it could have happened yesterday, or so on. If we set it to 1, it will only find the shares where the cross has occurred today. Let's do that. Click on OK. Here there's no extra value, it's either crossed or it isn't, so there's no minimum or maximum values to enter. We hit apply, and there we have it. We've got one share on FTSE 350 where the 20-day has crossed above 50-day EMA. And we can check. If we go to the chart, it's a daily chart, we go to add, and we go to moving averages. We'll delete this one, and we will create a red exponential 20 period exponential moving average, and we will then create a blue 50 period exponential moving average, and click on OK. And this is probably not a great pick anyway, but yes, technically it had dropped below yesterday, and it has now gone back above, so it's probably not a fantastic pick, but you can then select a different list of shares so you can see if there's anything interesting within the S&P 500, and there we go. Here's probably a better pick. There it is, cross just occurred today. If you look back 5 days, the look back, the 5-day look back, it is on any day in the last 5 days. So if we go back to the FTSE 350, we only have one result, but if we edit this and change it to 5, we'll get many more results, or at least maybe, we'll see. Yes, because there are shares where the cross occurred slightly further back, up to 5 days ago. So there we go. Here's a cross that occurred yesterday. So this is at any point in the last 5 periods. By the way, if you are interested in the technical analysis filters, if you go to the support page on our website, I have uploaded different videos for filtering on charts and technical analysis. So technical analysis, if you look at this section for MACD RSI, there's several examples. Plus, you can find the recording of the webinar I did on technical analysis and filtering. So there's more ideas there. But if you need any help, you can always give us a call or send us an email if you have any particular question or specific question. Right, if there are no more questions, I will stop the webinar here. So thank you very much for logging in this evening, and as always, if you do have any questions, feedback, please give us a call, send us an email. We are always available from 8 to 4:30 Monday to Friday to answer any of your questions. I hope you've enjoyed the webinar this evening, and I hope to see you soon. Thank you very much. Goodbye.